Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. And today's topic, I want to discuss with you index life insurance and, kind of what are the pros and cons of index life insurance and how you could essentially use it for either death benefit purposes or safe accumulation with eventual retirement supplement purposes. There's a whole different slew of ways that you could leverage these types of products, but you have to make sure that you're not making the most common mistakes that many individuals make, regarding indexed universal life. There are a lot of cons to these types of products, and if you could go and make sure that you're getting set up the proper way, then it could work out very advantageous for your position. So I just want to kind of highlight some of those different things. What happens is typically an individual is looking at this video because they might have came into contact with this through a financial advisor or some sort of life insurance specialist that was telling them something regarding cash value growth or cash value life insurance plans. And the way that the advisor most likely was making it sound was said, okay, listen, if you go and you take money and you place it into a life insurance plan, you're going to have a portion of that plan that's going to cover your death benefit, and then a secondary portion that's going to cover your cash value. So every single year, this individual is going to be paying premiums into this type of policy. Whatever is not paid towards that cost of insurance and all those other fees and charges associated with that death benefit and associated with that actual life insurance aspect of it, the remainder is going to go into the cash value. Okay, so this cash value is going to accumulate in two separate ways. The way that you have to look at that cash value is kind of like a savings account that you could take distributions from after a certain amount of time has elapsed. So this cash value is going to grow with whatever amount of money, whatever extra money is going into that year by year, is basically being placed into a bucket. This bucket is also going to grow by whatever the index that individual chose to incorporate with that cash value. So what I mean by that is you might have a couple different index options. You might have like an S&P 500 or Dow Jones Industrial Average, Dow Jones Industrial. So what happens is, let's say if your S&P 500 is 13% cap with a 0% floor, you understand that if you have, let's say, $100,000 in this bucket, just for easy math, and let's say the S&P 500 gained 10%, well, 10% is underneath the cap, so therefore you're going to have a credit of 10% onto that cash value bucket. Every single year that more and more contributions go into this bucket, you're going to be receiving interest credits from the amount of dollars that are being placed into that cash value and the overall existing cash value bucket. So there's certain ways on how you can accentuate this cash value, and that was the primary purpose of these index universal life policies, is to try to accumulate that cash value as much as possible, so you're having that compound interest that's going to keep spiraling within that account that you could eventually pull out in tax-free money later on. So all of this might sound like a lot of information, but you just have to understand how this product works and then how to essentially strip off all the negatives from this product to make sure that you're accentuating that cash value as much as possible. So just to be clear, there's two main people that are looking to purchase an IUL type policy. One could be for just primarily death benefit purposes, saying, I just want to have as much death benefit in that plan as possible, which I would not recommend an IUL for that. Or the other that's looking for pure accumulation with that cash value growth that is going to be taken out at a later date and time, and that's where I do recommend that. That's typically the cases that I deal with on a daily basis. This is typically where my recommendations go. So, once again, an individual is placing dollars into a policy. This policy is devised of cost of insurance, premium loads, different administrative charges that are within this plan. These plans are typically front-end loaded, meaning for the first 10 years, that's where these charges are going to be the most expensive. So any dollar already from the first years 1 through 10, any dollar that's above that exceeds these expenses are going to go into the secondary bucket known as the cash value. With that being said, this cash value is going to grow year by year by all the extra money that keeps going into that policy, and then also whatever that rate of return is through that indexing strategy that you are receiving. So individuals say, okay, well that sounds really good, especially where we have to look at the pros of this. The pros are essentially the money that is accumulated within that cash value is going to grow tax free. You're still going to be, because this is still under the house of life insurance, you still have life insurance there. It has to have a certain large death benefit there, or a death benefit that's higher than that cash value. So this death benefit is going to get paid out to beneficiaries in a tax-free manner. So the death benefit is going to be tax-free. The accumulation in the cash value is going to be tax-free. And then when you're looking to retire, what typical retirement accounts have, such as a 401k or an IRA, they have something known as 59.5 rules. With these cash value policies, they're non-qualified accounts and do not have a 59.5 rule, meaning if you want to start taking distributions in your 40s and your 50s, you could do that and you're not getting penalized by the IRS with that 59.5 rule. And when you are ready to take out this money, you could pull this money out in a tax-free manner as well. So you have tax-free accumulation, you have tax-free death benefit to your beneficiaries, and tax-free distributions. Those are the pros. The cons to this is you do have expenses every single year, and if you set up these plans the wrong way, if you go to the wrong agency to set them up, you're going to be paying more towards agency commissions, more towards agent commissions, more towards the cost of insurance, more towards death benefit, things that might not necessarily be as important to you as what was first described on how this product works. So with a typical policy, you might have something that looks like this little egg shape, where you have a lot of majority of your charges are going to be cost of insurance and all those different miscellaneous expenses, and you have a small portion going to the cash value. Well, the policies that we try to set up, and we say, okay, we ask you a whole slew of questions. If cash value accumulation, if max cash value accumulation is what correlates specifically to your goals, and you like that concept of tax-free growth, tax-free income, tax-free death benefit, then why not set up a plan that has the cost of insurance and all those different expenses be this small and have that cash value accumulation be this large, so that every dollar that you're placing into this plan, on one aspect it's sufficing the qualifications under the house of life insurance, but on the other aspect, you're making sure that the most amount of money is going into that cash value, so that you're netting the most amount of contributions into that cash value, and then that cash value accumulation is going to be largest with the best possible indexing strategies. Now, don't get me wrong, cash value accumulation always sounds perfect, and any advisor could illustrate some bogus rate of return. But you really have to understand how this cash value grows. What exactly is the amount of dollars that are growing into that cash value? What on top of the amount that's going into that cash value, what else is going to grow that cash value? And that's where these indexing strategies come into play. Now, rather than going with a company that might give you like a cap rate of 10%, or a smaller cap rate, or just a few options to choose from in your indexing strategies, why would you want to be handcuffed to a product that's not going to be your best possible scenario, your best possible option? So whenever dealing with IULs, I typically only go through three main carriers, because they're specifically designed for cash value accumulation. They're looking for the client that wants to really accentuate that cash value plan, to make sure that they're having the best possible indexing strategies in there. They're having the best possible growth opportunities within their cash value account. On top of it, your accumulation, you're going to keep accumulating in this product because it's going to grow in a tax-free manner. Anytime that you have a gain, it's all going to be tax deferred in a sense within that bucket. When it comes time to take distributions from that account, what are the right areas? What are the right products to take those distributions? Because you might have something that has really good cash value accumulation, but when it actually comes time to take money out, that's where the company's going to hit you with a gotcha type statement of, oh, gotcha, now you can't really pull out as much as you originally assumed. So that is where we dissect and we help, dependent upon your age, depending upon your specific situation, we make sure to navigate through the 300 plus different contracts out there for your specific goal. Some contracts are really favorable to somebody that's in their 30s, that's in their 40s, that's in their 50s, even in their 60s. Other contracts are not. So for the ones that I typically recommend, it usually goes by a variation of three major companies. One company in particular they've really honed in on how to accentuate that cash value, how to make sure that that cost of insurance and all those expenses are as low as possible so that your premium dollars are going to really accentuate that cash value as much as possible. When it comes time for distributions, how can you take that distribution out in a tax-free manner? Or while you're taking out distributions, how can your cash value still grow as you're pulling money out? And that's a process known as arbitraging your money. So, there's many different ways to skin the cat. You just want to make sure that you understand the most basic concepts of the cash value. And if you're placing dollars into a plan, how exactly is that dollar going to be accentuated the best possible way? And that's where you really have to focus in on the cons of this, is because if you go to an agency or an agent that is setting up your product, setting up your IUL policy, but they have too much on the cost of insurance because they have too large of a death benefit on there, or they have too many miscellaneous expenses to make sure that they have more and more commissions going into the actual agent pocket, that's not going to help you out. That's only going to help out the agent that's selling you that product. The other most important aspect is making sure that you're getting placed within the correct product, the correct niche scenario, the correct niche IUL for your specific situation. If you're 30, 35 years old, 50 years old, those are all going to be different types of products that are going to come out with the highest recommendations. You have over 300 different products and companies regarding Index Universal Life. Typically, I only recommend three main carriers, is because those three main carriers are going to understand, or they have those products set up the proper way where we could strip down that cost of insurance as much as possible. We could strip down all those miscellaneous expenses so that you're satisfied at every angle with how this IUL works. You're going to know exactly to the decimal point, okay, how much money can I expect to have within this plan? What are the growth opportunities within this plan? When it comes time for me to retire, how exactly can I pull out this money? Because that's another thing, is you have a lot of agents that just set up your plan and forget about you altogether. You want to make sure that you're dealing with an agent or an agency that is going to walk you through every year. They're going to explain to you what your growth is, what are some of your reallocation options that you have every single year until inception, until that time that you're looking to eventually take distributions from that plan. Because when you take distributions, you have to make sure that it comes out a specific way so that you're not getting hit with taxes, so that it's coming out tax free and the plan is being designed, is being leveraged the correct way possible. So, IULs are unbelievable products. It's what I have with my personal retirement, because I understand exactly how taxes are most likely going to be going up by the time I'm going to retire. I also do not want to wait till age 59 and a half to retire. So it works out perfectly for my scenario. That's why whenever I talk to individuals, I show them exactly the plan that I have. And I say, this is exactly why I set it up, my IUL, with this exact company, with this exact plan. These are exactly the accumulation that is happening with my plan. This is the death benefit that's going to go to my beneficiaries. And, it gives them the peace of mind as well. When calling in, we have a 1-800 number. It's 1-800-566-1002. We offer 24/7 customer service. So you could give us a call at any time, Saturday or Sunday or on holidays. We are A+ rated on the Better Business Bureau, and it's because of our methodical process. When you go give us a call, we're going to educate you. We're going to make sure that you're comfortable with everything. And it might be that an Index Universal Life policy might not be correct for your position. It's not right for everyone. But for that correct individual that really wants to utilize an IUL, you have to make sure that you're doing it the right way. You cannot make mistakes with this plan, because all that's going to mean is a majority of your dollars are going to go towards in the agent's pocket in the form of a commission, and your cash value is going to be as minimal as possible. We want to make sure that we're stripping away as much of those costs, the cost of insurance, as much as those different miscellaneous expenses, so that you're accentuating in that cash value, you're leveraging that indexing strategy the right way, and then when it comes time to retire, you're pulling out the most amount of money possible. That's what we try to do. We utilize something known as the Retire Sharp planning system. It's proprietary to our company, Afasi Financial Group. No other company, no other agency has it out there, and it allows us to go through over 1,200 different scenarios per individual before we give our top 3 recommendations. Once again, my name is Derek Afasi. I hope that you found value in this video. Feel free to give us a call at any time, and we'll be standing by to help you out. Thank you so much, guys.